All right, good afternoon. It is Tuesday around 4 p.m. Eastern Time, February 18th, and we are live. This is Lumida Non-Consensus Investing, and the focus here are 13F filings. Every quarter, my team and I pour through dozens of 13F filings, and then we go through dozens more of stocks and identify ideas that we think are interesting, that might be actionable. And I want to share with you some of our findings today. By the way, I've got a spreadsheet. You can download it if you go to the luminawealth.com website. If you go to my Twitter, you can find a post here. I'll share the screen here. But this document we compile after reviewing a number of these hedge funds and other asset managers, and we show the manager by type. We show their top positions or top 5 positions. Number one is their largest holding by weight. We show their new positions, which are often more interesting than the top positions, and also where they're selling down. And if you scroll down, we look at their position around Mag 7. We look at fund-specific moves at a thematic level or some interesting callouts, certain stocks, what's happening there. And we also have a category called Front Run, just for fun, where we talk about managers that are selling large blocks of stock from a top position, like Bill Ackman selling Chipotle Mexican Grill, which hasn't gone really anywhere since we pointed out that front run from May of last year. So there's a lot to get into here. I mean, there's really an incredible volume of content information in these 13Fs. So my team and I were on this really Friday night when they started to really flow back in, and it's really been nonstop. And I started doing this last year, and the investment team then was Ram. Now we have four total on the team, 2 of which are CFA charter holders, and we're recruiting more. So the team is growing, and we've got 3 engineers now. Last year we had 0 engineers. So we're going to be creating a lot more content, a lot more analytics, and I'll have a lot more to share with you too. Lumina is growing. We're having a lot of fun. We had a fantastic year last year. We're going to share with you our audited returns soon from a third party, so more to come on that. As I go through this, also call out what we bought this morning. So it's been busy. All right, let's dig into this. So I like looking at, first off, what are the top holdings? What's in the top position? Now, in last quarter, the number one Mag 7 name, really number one security that was held by top position across these hedge funds was Meta. And of course, Meta just concluded something like a 21-day winning streak. Today might be the first day where Meta had a down day. Yeah, today is the first day where Meta had a down day. Take a look. First large red candle. Our last buy point was right there, actually, November 18th. That's a good buy point. Obviously, we've been a bull for Meta this year and last year. Really, within Mag 7, NVIDIA, Meta, and Google, those have been our favorite picks, with Amazon from time to time. So there's some value from this. In May of 23, we saw that NVIDIA was in the top position for hedge funds. So the point is, it's not a popularity contest. Don't walk away with that. That's really the wrong conclusion. You don't want to do that. In fact, some of the best ideas are small names no one heard about that's got a 1.5% weight in a fund. And we take a closer look at that, and you find that there's a really interesting opportunity there. I think that's where the most of the value is. But it does force you to challenge your thinking. If you see a name that is kind of moving up the leaderboard or moving down the leaderboard, and you've got a different perception to it, at the very least, it forces some critical thinking. So we find that is very helpful. And, you might find some confirmation bias here too. You'll notice like Tesla is not, for example, in a top 1, 2, 3, 4, 5, 6, 7, or 8 position. It's a popular retail stock, but it's not really an institutional stock. So that's something to consider. The other question that comes up often is like, hey, is there value in these 13Fs? They're released 45 days after quarter end close. So isn't this stale? say, no, there's a lot of value because most hedge funds are tax sensitive because they pass taxes as limited pool vehicles to their LPs, and LPs are tax sensitive. So yeah, they care about that. Their holding periods are long. And certain funds like Point72 have much higher turnover, and you can account for that, or Millennium will have much higher turnover. Value funds have longer holding periods. If you look at the top name for Druckenmiller, Kupang, he's had it for years. I wouldn't buy that, by the way. He's selling that down. But yeah, there's value there. And sometimes you can find entries that are better than when these funds bought them, which is always fun. So they did the due diligence and you get a better entry point than they did. That's always satisfying when you can get it, when you can find those opportunities. So, that was one quick observation. If you look at in the Mag 7, what has a top position, meaning a top 5 position? NVIDIA has 13 in the top position. 3 funds removed it. Microsoft has 15 slots in the top position. 3 are new initiated positions. Again, this is as of December 31st. Amazon 14, 6 funds have removed it. Amazon, we liked actually it's really kind of run up quite a bit now. Google's got 6 slots in the top position, and then there's Meta, 13, Apple 10, Tesla 2 in the top position, 5 new kind of initiated positions. So there was a Q4 bump that several of these hedge funds participated in, including, I believe, Renaissance Technologies. We'll come back to that. Oracle not really showing up there on the leaderboard, and Taiwan Semiconductor 4 appearances, Uber 3 appearances in the kind of top position area. So let's take a look at this spreadsheet. Now, the way it works is we color code too, so you can quickly spot common names across different funds. Not all of these funds are great. Some of them are exceptional. I'm going to focus on some of the funds that I like. We do have specialist funds too. There's some funds that only specialize in, say, energy, like Horizon Kinetics, or you'll have a fund like Whale Rock that only focuses on technology stocks, or like Altimeter, for example. You have like Bob Rabati, who has a bias to value and looks for inflection points. I like that kind of thought process. You've got Seth Klarman, Baupost looks at value, deep value orientation. And then you've got other managers that prefer momentum. Druckenmiller would be an example of that. I think Point72 is an example of that as well. So take a look. You've got Jeremy Grantham is in here too. You can see he's loaded up on Microsoft, Apple, Google, Meta. I always find that kind of funny because he's often described as like a perma bear, and this guy owns quite a few names in Mag 7. Now, to his credit, his overall weight in Mag 7 is less than the benchmark weight. That'd probably be what he would say, if he was here today. So some other quick top level observations. Let's take a look at Druckenmiller's portfolio. I really enjoy going through Druckenmiller's portfolio. If you look at stocks and themes all day long, when you look at someone's portfolio, you have an immediate grasp of their thought process, the themes are focused on, the names they like. And if you look at them quarter after quarter, you can start to back out what their approach and their style is. And when you look at some 13F holdings, they really are a work of art. You look at it and you're like, oh, these are really original ideas. Other people don't own them. And often I have that feeling when I look at Druck's portfolio and Point72's portfolio. So I enjoy looking at those two. And so we'll spend time on those as well. Although there were surprises across the board. We had like Renaissance and Millennium owning like Reddit, for example. Some interesting surprises that showed up here. You would think that some of these stocks would be in the hands of retail investors, but they're not. So we'll talk about that too. So let's get to Druck's portfolio. This is a Duquesne family office. Druck on his Form 13F, he's got 78 holdings. So he's not a concentrated investor, although you could say he's concentrated around a couple of themes. He's a thematic investor, just like we are. We're very highly thematic. So he's got a theme around banks. We talked about that last quarter. An emerging theme in pharma, materials. He's got U.S. Steel, beneficiary of the tariffs. By the way, be careful of chasing these ideas. This is now, some of these event-driven ideas linked to regulation that may be behind us. So just kind of understand where you are in that information flow. Asset managers, semiconductors, Argentina. He's got one or two commodity plays as well. So he's got, 6 or 7 themes. Now, if you recall last quarter, and I recommend, by the way, I would recommend listening to our 13F analysis last quarter. I actually listened to it over the weekend. And I was struck by how many of the ideas we identified worked really well. One example are the Argentinian banks, Banco Macro, GGAL, they worked very well. In fact, we bought some BMA this morning on the Argentinian gap lower, 4% lower. Now it's down 20 bips. So we picked up more of that. We think that's probably the best play in Argentina. But what we noticed about Druck's portfolio is that he actually trimmed quite a few of his regional banks, including some of the names we independently like and own. So, and he's focused on some clever opportunities. One is Barclays. So Barclays is a European bank. We've been focused on these European banks as well. I think it's a good idea. It's a name that ran up a couple points as soon as Druck's 13F was published. So it's not really letting you get a good entry. Eventually it will. I don't think you need to chase. Look, Barclays is up 5% today. I'm going to share my screen here. So there are algos and or teams that are waiting for the drop. And here you can see Barclays gap up 5%. And if you look at this name, this has got a forward PE of 7.2. So it's very cheap. It's got a lot of momentum also. It's up 100% a year. By the way, consider that it's had that price return and it's still cheap. This is one of my favorite patterns, actually, when you can get momentum, value, and quality all together with a nice uptrend. That is a Druck favorite too. It's a Paul Tudor Jones favorite. It's a lot of favorites. So I think this idea is a good one, and also fits with a broader theme of international value working. International value is something we've been focused on. I wrote a newsletter about a month ago, and the newsletter was titled about tariffs are here, Meta, GM, and Tesla earnings. And we noted this. We noted that when foreign investors are piling into the U.S. market, they're leaving their home market cheap. And a strong dollar means focusing on international markets. It's a good idea. Markets like Brazil and China have rallied nicely in recent weeks, and they've outperformed U.S. markets. If you take a look at international markets today, they continue to outperform the S&P 500, and that's been the story for several weeks. So, we think there are opportunities in international value, especially when the S&P is at elevated valuations. There were great bargains in Mag 7 not too long ago. Remember NVIDIA? My last show, I talked about how we got constructive on data center, and we bought NVIDIA the very next day, as well as some independent power producers and under names in the data center theme. That's all recovered, right? NVIDIA is now like 140. It was at 118 back then. So within Mag 7, it's hard to find bargains. I think NVIDIA will still do fine. I think they'll report earnings. I think their, PEG ratios are more attractive than other names, but it's no longer a great deal. I kind of joke that the best deal in Mag 7 now is like Taiwan Semiconductor. It's not a Mag 7, but it's like 18 times PE, and it's cheaper than these other Mag 7 names, and is of course directly indexed to the rise of data centers, right? Elon built a super data center, the largest data center in the world in Memphis, Tennessee. It's got more NVIDIA chips than anywhere else in the world. He's building a new one. And NVIDIA is a beneficiary of that, and TSM is a beneficiary of that. It's followed the supply chain. The market has finally not focused on TSM. So there were some good entries even today. So we picked up some TSM today as well. And obviously a couple other hedge funds bought TSM. Let's take a look. Steve Mandel from Lone Pine. Steve Mandel and I actually went to the same high school. he's a tiger cub, very, very skillful investor. And let's see, Viking Global also got some TSM. Dan Loeb, 0.72. Stevie Cohen, of course. And so yeah, you've got a couple buyers of that. I think it's a good idea. Again, it's not a steal, but I think it's a better way to substitute for pricey Mag 7 exposure. Netflix is pricey. Meta is now fully valued, right? Meta was priced out of AI. Now the market realized that they've got a great story. They grew earnings 40% year over year. And it went from a 23 PE ratio forward to a 34 PE ratio in a month and a half. So that's probably fully valued now, right? But TSM, we think, is probably been kind of left out in the cold, and there's some opportunity around that. Back to Druck's portfolio. So on banks, he still likes banks. He picked up Sallie Mae. This is a clever idea, actually, and it makes a lot of sense. We think about the regulation one can expect in the Trump administration. Now, Sallie Mae really was a leading private student lender prior to the Obama presidency, and that presidency really transformed student lending, and to the detriment of Sallie Mae. So it looks like he's betting on a pendulum reversal back to maybe more private student lending, which would benefit Sallie Mae and maybe other services in the market. So I want to dig into that. I thought it was just a clever idea. He has some other banks too, like First Horizon and USB Bank. We did take a closer look at USB Bank, and you can see it there. I think it's interesting. Although I think quite a few regional banks are interesting. Although the European banks are even more appetizing. If we look at the statistics we just described not too long ago. So he's also got an emerging pharma bet. So he picked up Pure Cycle Technologies, and all these stocks like pumped real quick. I want to chase these. Look at this. That's the Druck effect, up 16% on a high volume. So wait for this to come back and then reconsider, reassess. We don't own this, but it's on our tracker. We'll take a closer look later. The way we prioritize our research is if there's a good entry, then prioritize the research. And if it's on theme, prioritize it. If it's not, then you have time. So that's how we triage the work we're doing on our side. What else? He picked up a Verona. He's got exposure to Teva, which is a generics pharma company. And Teva got a bit of a bump today as well. I'll share my screen. Also has an interesting entry. So what's not clear is what is Trump's America First policy for pharma, and how does that interact with Teva? It's an Israeli-based company. Obviously, generics can play an important role in reducing the cost of medicine, and it's cheap. Forward PE is 6.5. So I do think there's an opportunity there. We do own this, but you're waiting for regulatory clarity. What exactly does RFK Jr. want to do with the Department of Health? Pharmacy stocks are very cheap right now. So, and they've sold off, they've really corrected because of this regulatory risk. So interesting to see him pick up that. Now he got a couple of semis as well. Western Digital, for example, really betting on data centers via the demand for memory, NAND memory. You need hard drives, you need terabytes and terabytes of data to store all of your personal information, and trust that in the hands of big tech companies. So Argentina, he added to BMA. This is one of the Lumida stocking stuffer stock picks. I love this business. We bought more this morning, actually. And they are the leading private bank in Argentina. Argentina, of course, has done really quite well since the new prime minister, Milei. And if you look at this stock has gone up 192%. And again, the PE ratio is 8.2 forward. Again, this is what I look for: momentum, value, and it's a quality business model. Private banking is a good business model. Banking is a good business model. If you take a bank and you give it wealth management, you're taking two business models and putting together. That's actually the vision for Lumida, by the way. I want to buy a bank one day and then build a private bank, and Lumida Wealth is the first installment in that vision. So it's a good business. First Republic had this business model. First Republic, when General Atlantic bought it from Merrill in 2008, they paid about $1 billion in change. They took it into public markets, and it 40x'd in public markets before it went to a zero. But went to a zero not because of the business model, went to a zero because the CFO did not sell their fixed rate mortgages. They did not securitize them. They're supposed to sell to JP Morgan. They did not do that. So they were upside down on their long-term yields in their mortgage book. Fantastic business that JP Morgan picked up. Subsequent to that, we bought JP Morgan because we knew they're getting a great asset. That was back in 2023 spring, obviously. What else? So he also added to GGAL. We actually like BMA more. We did own GGAL, but I think on a relative valuation basis, BMA is better and a better business model. So qualitatively, we prefer BMA. He also picked up industrials like Wabtec. He owns Flux. This is one of our names too. This is actually an Lumida stocking stuffer. This is indexed to the data center theme. So Flextronics. I look at them as like a cheaper version of Celestica, which we've owned and we've really enjoyed that. It's got good earnings growth. The valuation is fair, right? You're talking like a 17 times trailing, 15 times forward PE. So he also reduced his KRE exposure. So KRE is an ETF for regional banks. And let's pull up KRE to see what his thought process was. So these 13 Fs are filed December 31st. Druck loves selling into parabolas. That's a common theme that I see every quarter, right? He sold NVIDIA around March or April, and he never looks back. When he rotates out, he moves on. So my guess is that's what he did here. He also, in fact, he sold out of VST, independent power producer, right? There are three major IPPs, Constellation Energy, Vistra, Talon's another one. We own Talon. So he sold out of VST. This is a name we owned last year, actually. So take a look at VST. We sold out of VST here in this, right when that arrow was. There was a nice little mini Bravo there. But he sold out of GEV as well. That is a GE spinoff. All the GE spinoffs have done quite well. Obviously, the stock is expensive now, and he's not in it. So he really knows how to, get out while the going is good, and then these things just kind of consolidate and go nowhere for some time. He times his sells very well. He sold KMI. KMI we mentioned last quarter. So in the last 13F, we pointed out how Druckenmiller owned KMI. This stock also got really hammered during that DeepSeek news. In fact, we talked about it on the podcast. And take a look. So again, he timed his exit very well. Druck is good at getting into ideas before other people pick up on those themes, and he's really good at rotating out. Now, here's a surprise theme. I think people may not be focused on this, but Airlines. So he owns United, American, and Delta. Funny enough, my team and I were looking at this category last Wednesday, and we have a CIO call every morning, 7 a.m. And I drop some live thoughts in my Telegram chat. And I remember on Wednesday, I said, hey, airlines look good, momentum strong, EPS growth strong, valuation's great, consumer strong. And they're not really engaging in competition like they used to. Each of these airline companies have discrete segments that they focus on, right? And certain hubs and certain routes that they tend to dominate and own. So if you take a look at, American Airlines, we bought this name, 6.7 forward PE, 13 times trailing. They're paying off their debt. It's a highly indebted business. It's got a debt payback yield of 26%. I'm not worried about the high debt because capital markets are open, and I think long-term rates stay under 5% here, and they're generating a ton of free cash flow. So I think the debt payback is actually fine. I think it's okay to have leverage, provided you don't have, near term, a liquidity risk, right? You got to make sure interest coverage ratios are adequate in the near term. So obviously, these guys have a major hub in Dallas, Fort Worth, and Chicago, LaGuardia in the New York area. So we like this because the value. We like the debt payback yield. I don't know if we'll ever see airlines have share buybacks, but if that debt gets paid off in a couple of years, maybe. I don't think they will. It'd be really funny if that happened. Airlines are a category that Buffett famously ignores, and he just doesn't like to invest in. He did invest in Delta, and then he sold it on the bottom. So here's Delta. He sold it in one of these bottoms, like somewhere in the post-COVID era. And but Delta's done well. Also, we own Delta. Obviously, Delta has the Northeast Corridor, right? Boston, New York, DC, that route, the shuttle commute route. Fortunately, no lives lost in that tragic accident we had yesterday. So, but this is an interesting idea. So you've got a valuation that is attractive and a strong earnings growth, right? Let's take a look at the earnings growth. Now, these are analyst estimates. Analysts are often wrong. So I try to handicap, are the analysts can be wrong in the upside or wrong in the downside. My view is that the consumer is stronger than most people think. And we're seeing that in a number of different surveys and data. So 39% earnings growth next year is the analyst estimate for December 2025. And they show more moderate earnings growth in 26 and 27. I mean, this is similar to like the cruise theme, right? Cruise stocks have done really well post-COVID, right? Royal Caribbean, Carnival Cruise Lines. Now, those names are getting more expensive. They're certainly more expensive than airline. If you want to go on a cruise, you got to get on a plane to go to the cruise ship. And so this theme is an interesting kind of idea. It's like a fast follow theme, and it's indexed to travel and leisure. And quite a few travel and leisure stocks have done well. They've reported earnings. They've beaten, and this is a boomer economy. What are boomers doing? Boomers are spending on travel. In fact, we've got a whole theme indexed to boomers. What are boomers spending on? They're spending money on insurance annuities. They're spending money on wealth management, stocks like LPLA. They are also spending money on travel and restaurants. Follow what the boomers are doing. Who's talking about the boomers? I think it's a great investment theme. So we like the boomer theme. So there's Delta. Maybe sold off on some of the news that took place recently. We'll see. Arguably some of these are extended, so you can position size accordingly. It's right there in the 50-day. I think that's not a bad entry point. So to get a starter position there. So that's it. Druck is involved with airlines. I think that's a clever idea. If you believe the economy is strong, I think that move makes sense. I mean, other travel stocks are more expensive than airlines. It's a cyclical business, by the way. These are not businesses you want to own in a recession. There's no evidence of a recession in sight. Our view is that we have the hot landing thesis. The economy is stronger than people think. That's been our view for the last 2 years. And I don't see that changing. In fact, airlines might also benefit from the focus of Scott Bessent, Treasury Secretary, to lower energy prices. I mean, they want to get oil prices low, and they want to get the 10-year low. So if you have a lot of debt, then you can refinance. I was listening to the Odd Lots interview with Howard Marks. Howard Marks, one of these legendary cross-asset private and public market investors. You're supposed to read or listen to Howard once a year. It's like going through a car wash for your brain to reorient on first principles. And he had very good observation that bears repeating. He says, debt is never paid back. Debt is refinanced. Debt is never paid back. Debt is refinanced. Anyone that has taken a 30-year mortgage and has moved homes knows what that means. Average duration of a mortgage is about 5 to 7 years. So in the case of highly levered firms like an airline, I would expect that they will have access to favorable refinancing conditions. Capital markets are wide open. You'll get an IPO market later this year. The bond market is doing fine. Look at high yield credit spreads. They are tight. So there's ample opportunities to refinance. So debt always isn't bad on the balance sheet. It really depends on the broader environment. So let's take a look at Altimeter. I made a bet with Altimeter actually last year on who had better performance. They did something like 36%. We're going to come very close, either just above or just below. We're going to get the audited results in a few weeks. We have dozens and dozens of accounts. So it's not simply looking at a time series returns. We have like 35 time series returns that need a time weighted analysis, and you have to have a third party do that work for you. But we'll come very close. But take a look at Altimeter. This is Brad Gerstner's fund. I think Brad's a thoughtful tech investor. I don't always agree with him, but we're very non-consensus, so that should come as no surprise. But he does have our top holdings, Meta and NVIDIA. These were recent bills for Brad. He picked up NVIDIA. He announced prominently on CNBC sometime this summer. He said NVIDIA was our top position. Since then, he made Meta's top. Those are our names, right? So imitation loves flattery. Is that the expression? So we're glad to see Brad join us here. One difference, though, is that Brad has a sizable position weight here, which is very different than our investment philosophy. I do think diversification across themes and within themes can work. You want to find multiple bets so that you can apply your edge and diversify away the idiosyncratic risk. Diversification is a free lunch. It's the only free lunch in investing. But you want to avoid things that have contracting earnings growth. You don't want to avoid things that have balance sheet issues. You want to avoid things in downtrends, right? So screen away those opportunities, focus on things that will do well, have opportunities for multiple expansion. And I believe that's a good recipe for the S&P to beat the S&P, and it's certainly been working for us. So he's got exposure in Snowflake. He's been trimming. Meta, he trimmed 20%. That was December 31st, by the way. So, those sales caused him to miss that more recent rally. I was surprised that he trimmed Uber. We were adding Uber at the year end. You can find that on Twitter. And then Bill Ackman added it in early January. That's satisfying too. But we had a fantastic entry on Uber. I'll show you when we got into Uber. Okay. This is Uber. This is our entry on Uber. And then we re-entered Uber right here on the pullback. So Uber, strong free cash flow growth and decent valuation. Back to Altimeter. So, I think the NVIDIA idea makes sense. Microsoft, they pull back on. I agree with that. Microsoft has really gone nowhere. It's lagged the S&P 500. It's a consensus idea. They own OpenAI, and that's why they got bid up in 23. But owning a chunk of OpenAI means you got to pay the bills. So CapEx is a drag. CapEx is on average a drag because those are expenses. Interesting thing about Microsoft, though, is that they're raising prices on software. That will boost revenue and earnings. Now, how much is it going to be material and so forth? I think it will be material, but that could be an opportunity. I don't own it. This is a good analytic. This is where you need a DCF model. You break it up by business line, and you say, hey, if these price increases flow through and there's this adoption rate on that, like 80 to 90% will pay that higher price because it is a monopoly. Then maybe that's interesting. But I think there are better opportunities like TSM, for example. So let's see what else. He trimmed some Amazon. I think that makes sense. Google, he loaded up on. We also loaded up on Google. I don't like the fact that Google is ramping up a lot of CapEx spend, but it is still cheap relative to the other Mag 7 names. He sold off a lot of Tesla. That was smart. So he benefited from the Q4 Tesla rally. Then he sold half his position. Was never really a major position though, right? So, this is maybe Elon Musk relationship value. Who knows, right? There, Druckenmiller owns a bit of Palantir, but it's like less than 1% of his portfolio is de minimis. And I believe he's an early investor in Palantir. He's friends with the founder, Joe Lonsdale. It's just relationship value. Some of this is just optics. So you can walk around and say, hey, Druck's an investor in Palantir, right? So looking at the size of the exposure can matter too. And they got TSM, they reduced that. I think I'd be a buyer here. Zillow, he loaded up 50%. So we looked at Zillow very closely over the weekend. I think Zillow, we don't like it because of share-based compensation. That's the shortcut. They have an absurd, excessive amount of share-based compensation, which is essentially a form of legalized management theft from shareholders, okay? Meaning they're issuing shares to executives. That's the bear case. What I like about Zillow, it's top of recall app for browsing for homes. And it's, digital economic model. They shut down this iHome business, which is capital intensive. But that's the issue with Zillow. There's another business like this too. This is Zillow here. It's 45 PE now. So I think it's got kind of some retail momentum behind it. But the share-based compensation means that I gotta say I'm out. That's my Mark Cuban on this. I'm out. I gotta pass. Here's another business, by the way, that I think is one of the best businesses in the world, but for the fact they have excessive share-based compensation. It's absurd. This business, and you all know it, if you've been to the airport, it's called Clear, right? You go to the airport and you get that express lane. They scan your eyeballs, you zip right through, privacy be damned, right? And people will pay for convenience. And it's a SaaS model. They can upgrade you. No one looks at the price increase. We're in a convenience on-demand world. So it's a wonderful, wonderful business model. And they got a monopoly. So the issue with Clear is share-based compensation is excessive. It's excessive. This stock would do much better if they had a board that reduced share-based compensation. And instead, if they just focused on share buybacks. There are other companies like this too, by the way, like Yelp. Yelp is interesting, but once again, high share-based compensation. This is a stat that not many investors look at. Institutional investors, professional investors will look at it if they're worth their salt, if they do their homework. It's usually like diligence point number 9. Sometimes people forget about it. It's a very important feature though, especially if you're looking at tech stocks. Look at ARM. ARM, not just high valuation, but high share-based compensation as well. That's an easy pass. So, be wary of share-based compensation. All right, let's get back to some other names. I really enjoy looking at 0.72 as well. So let's take a look at that. Again, very, very thoughtful investors. When you look at their holdings, let me pull this up here, 0.72. Steve Cohen. All right, 0.72. Stamford, Connecticut. Second. There we go. So, Steve Cohen, phenomenal investor. In 2022, he made money when virtually every asset class went down. He did that by owning energy stocks, right? Bonds went down. Virtually every asset class in stocks went down. Incredibly difficult environment. He did well, and I think he eked out like 10%, which is still a heroic performance. So let's take a look at what Steve has been doing. A couple observations. So they also have some thematic ideas. They have more themes than Druck does. They also have the travel theme. They bought American Airlines. You can see that here. They increased their position, in percentage terms around 500% or so. They have a consumer theme. They picked up Netflix, small position though. I think Netflix is kind of overvalued where it is here. They also doubled the position in cruise lines, Carnival Cruise and Boeing. Talk about a non-consensus idea. Remember, everyone's talking about Boeing. Everyone forgot about Boeing. Everyone hates Boeing. They doubled their position in Boeing. I think they're better ideas than Boeing though. They have new positions in stocks like Coca-Cola, which have sold off. So some consumer staples they picked up. Quite a few different hedge funds actually picked up Coke. So take a look at Coke real quick. There's Coke. Okay, 23.4 PE. I think this is the 13F pump right there, right? So, maybe people had an early look into these 13Fs, or some hedge funds released their 13Fs earlier. I don't think it's a good entry point here. Coke and these other consumer staples have suffered from the rise of these GLP-1s and Ozempic. I was looking at a transcript this weekend for a stock called Buckle. They are a retail apparel store, and women's jean sales are up double digits. Think about that. Jean sales are up double digits. Ozempic effect is at work. I mean, Ozempic is changing a lot of fortunes for these various stocks. I mean, look at like Weight Watchers, for example, destroyed. This is Weight Watchers International. Look at this, totally destroyed. 62 million market cap. It was at $34 a share. Now it's 79 cents. 34 and 21. Take a look at Medifast. Okay, Medifast. This is called the Ozempic effect. And it is really reshaping behavior. How many of you are trading in your wardrobe? What's the impact on gym memberships? Would be an interesting question to ask. We haven't really seen it hit that category yet, actually. Those stocks are still doing just fine. But it has hurt consumer staples, right? Take a look at, say, MDLZ, Mondelez, right? This one also hasn't done well. So these are, consumer staples are, kind of generally seen as a category as a classic Buffett businesses. They're small dollar, you can pass through cost to the customer. They have a strong brand. They're business models that are immune from disruption, not going to get disrupted by AI, but they can get disrupted by Ozempic, apparently. And they're still not exactly cheap, despite the price declines here. And they're not cheap because earnings have also declined. So I'm in the avoid category overall. I think Coke was an interesting idea, though, a few months ago. Or, I mean, the thing is, when Coke was a good idea, so was NVIDIA. That's the problem. And I rather own NVIDIA and those data center themes. Like, if you own Coke now, what do you do here? You can sell and pay taxes, but now you miss your NVIDIA upside. So we see these problems all the time, by the way. We see opportunities in multiple sectors, but you have to ask yourself, what's a better longer term opportunity? Otherwise, you're going to pay taxes. So, staples, while we're on the topic of staples, take a look at Walmart and Costco. Now, these have also had one hell of a journey, like Meta. And Walmart is more expensive than NVIDIA now. So is Costco. This is part of the a news that I wrote called The Bubble in Quality. I wrote it 2 weekends ago and kind of reiterated the point this weekend that we've got a bubble in quality stocks. Look at this. It's 57 times 4 PE. It's more expensive than Amazon, a lot more expensive than Amazon, more expensive than Netflix, certainly Google and Meta. And this is now pulling back. So, this is part of the staples category. This is part of XLP. Take a look at the top holdings. Costco, Walmart, Procter & Gamble, Coke, Philip Morris. How about Philip Morris? We talked about Philip Morris last quarter. This has done very well. That was a 13F finding from last quarter. I won't walk through the thesis. Obviously run up since then. We want to focus on ideas that haven't run up. That's where the opportunities are. But just another, evidence that 13F analysis can be very, very effective. What else is 0.72 buy? They picked up various data center names like ETR. ETR up 6%. Again, that's a 13F effect. Strong momentum, strong trend, earnings growth on theme. This is a classic 0.72 type of idea. Now, 0.72, they have many positions. Look at this. They have 2,000 holdings, okay? 0.72 is one of the best investors in the world. So if you don't think diversification works, look at Point72, look at Citadel, look at Two Sigma, look at Jane Street, look at Jump, look at Millennium Rentec. Okay, so they have a lot of positions. A lot of their positions look like this, actually. This is the characteristic of a Point72. I like this category of ideas as well. It's like maybe a half to 2/3 of what I do. I don't own this name, but there are other names that have this kind of profile. For example, I'll show you this one. I think AXS. This is an insurance company with a good valuation, earnings growth, and momentum. It's up about 52% in a year. And it's on a theme that I think will do well in the insurance category, right? So, yeah, Point72 has a lot to work through. The position sizing in Point72 is generally equal weight. They have a lot of small positions, which if you have skill, that's a very good idea because you're indexing your portfolio to right-tailed outcomes. You're not overweighting a name that just creates more risk than you really need in your portfolio. So I think it's a very thoughtful approach to portfolio construction. It's hard for most people to kind of take this approach, though. I mean, these guys are incredibly active. They own Cisco. We own Cisco too. So telecom bet. Cisco is an implicit data center idea, isn't it? So remember in 23 and early 24, the way to bet on data center growth, which is a massive trend, look at CoreWeave, look at Oracle, look at Stargate, look at French Prime Minister Macron talking about data center over lunch with Sam Altman, look at Japan, China, right? The way to bet on data center in 23 and 24 was semiconductors. And we had a nice little bubble in semiconductors. And since then, we've seen that market split between the winners like NVIDIA and TSM, and then the rest. And there are these kind of other layers to the onion on the data center theme. We talked about Western Digital and Seagate earlier. There is more attention on those names, I would say, but interesting idea. Less attention on names like Cisco. So I think this is a good idea. The funny thing about Cisco is people love to compare NVIDIA to Cisco. And Cisco is actually, take a look at the earnings growth. You can see the earnings growth and the difference between their forward PE and trailing PE. Obviously, it's run up. It ran up on Friday. It's overextended here. And again, it has a lot of the qualities that I look for, right? Momentum, earnings growth, good valuation, right? If their valuation holds and they deliver earnings, then the stock on average should go up by the amount of earnings per share. And if they have buybacks, even better. I'm not going to walk through our entire write-up and thesis on these names. We won't have time. But, it's got 20% ROE. It does have some modest buybacks as well. But I like that idea. We own that idea also. Here's a funny one, by the way. Tiger Global. I mentioned earlier, I'm not a big Tiger Global fan, by the way. I think, they overpay in private markets. They did get Meta right, to their credit, which is good. But so do a lot of other hedge funds. Again, its most popular hedge fund name is Meta. Certainly was going into this 13F season and still is now. But they have a China bet, small random company in China, Ding Dong Limited, Cayman Islands based, strong earnings growth, market cap less than $1 billion. We're researching this name right now. I think that's an interesting idea, actually. Again, it's got momentum, it's got earnings growth, price free cash flow is 7. They're paying down their debt, ROE is high. So quantitatively, it meets certain characteristics. It's got an e-com play, interesting idea. So fresh groceries. I got to learn more about it. I don't know, maybe it's like an Instacart for China or like a DoorDash for China. Maybe that's the idea. But what's going on, Stein? I'm doing well. Hope you are well. Thanks for the shout out. And got a question here. How important is economic outlook for a hedge fund? It matters for some, not for others. Citadel, Two Sigma, they don't care about the economic outlook. They can be market neutral. It really depends on the approach that they're taking. Most hedge funds are long biased, so they do care about the outlook. Many don't incorporate it because they believe it's very hard to incorporate it, especially tiger cubs. Julian Simon's Julian Robertson. Sorry, Julian Simon is the guy who said human capital is the most precious form of capital, right? Julian Robertson, kind of OG Tiger, once said, the great thing about growth stocks is eventually earnings growth will bail you out. He's like, well, if you time it bad, earnings growth shows up and will bail you out. Look, I think it's the other side of that, by the way, is the Howard Marks point. I referenced Howard Marks earlier. He says a good investor knows how to buy well. And that's actually my approach. Something I say quite often is you make your money on the buy. Anyone in real estate knows that. If you pay too much in real estate, you're screwed. Doesn't matter what kind of asset you bought. You're going to be upside down. So, you have to buy well. And that includes for growth stocks because you can face multiple compression as an expensive stock contracts to a less expensive stock, like we saw Polaroid do during the Nifty 50, right? Polaroid had like a 90 PE ratio. It was like the hottest thing since the Ritz Cracker, which was the growth stock before that. Ritz Cracker is a value stock now, right? So airlines were growth stocks. Now we're talking about PE ratios of 7 times earnings. So eventually there are limits to growth and you get multiple compression. So I think if you look at these amazing investors like Druck, they are valuation sensitive. Did you see any name that Druck owned that was pricing expensive? I didn't see that. I think he had a tad of ARM, which I didn't fully get, maybe. But that's the best counterexample I can find. But by and large, he does focus on opportunities that have multiple expansion. So that's 0.72. They had some healthcare names as well. We have been buying healthcare names, including this morning. I think healthcare is one of the few sectors now that have opportunity and value in the market. Again, they sold off because of questions around RFK and Department of Health and Human Services. What does it mean for policy? But healthcare spend as a percent of GDP is only going up. I hope they reduce and rationalize the cost of care. It's extraordinarily difficult to accomplish. It's not going to happen this year. Won't happen next year. You'll see some policy ideas develop after tax cuts are passed in the back half of this year. But I think, when you have a sentiment-driven correction that's not matched by deterioration in fundamentals, and you've got quality businesses that are compounders, I think that is usually a viable opportunity. So let's see, 0.72, they also did the Uber bet. They doubled their position. Uber, go 0.72. We did that deal as well. Let's see. They got Intuit. Intuit's an interesting name that, again, it's not a big position, but they do have some Intuit. It's not a great deal, but it's pricing better than it has historically. Let me see other call outs. Airline, Alaska Air Group. Remember we talked about airlines with the Druck? They bought Alaska Air Group. And again, take a look. That's a classic 0.72 stock right there. So, what else? Okay. Mercado Libre, they leaned into the dip in Brazil, right? Brazil has done well. Brazil is beating the S&P year to date. Okay. So they picked up some Brazilian names. So there's more. Like there's so many names in 0.72's portfolio. I think we can do an entire podcast dedicated to 0.72, and it would absolutely be worth it because it is a very thoughtful portfolio. I've sometimes toyed with the idea of having an analyst only generate ideas from the universe of 0.72 stocks. I think it'd be an interesting idea. So let's see. Let's keep going here. Okay, Michael Burry. Everyone loves to see what Michael Burry's doing. Look, it's not hard to know what Michael Burry's doing. He's going to buy the cheapest, most dislocated thing in the world. And that's obviously China. So he hasn't really kind of remaneuvered around that. I mean, it's still BABA. He's starting to trim. He sold BABA a little bit too early. 25% position reduction, JD.com position reduction, and he sold Baidu. What happened? Michael Burry, you sold too early. Look, the pros make mistakes too. That's one lesson. Don't beat yourself up. But what did he buy? He made a good bet on Estee Lauder. That's a good idea. I mean, actually, I wouldn't buy it. I think purchasing behavior is shifting towards convenience and value away from luxury. Okay. So people want experiences, people want services. That said, these luxury stocks have rallied just as China has bounced back. China's indexed to the luxury theme. Look at like Louis Vuitton and look at, say, the FXI index. They go together. People in China love Louis Vuitton handbags. But let's take a look at Estee Lauder. Again, this is a business something will be wrong with me if I ever buy a business like this. I mean, it's got a 41 times forward PE ratio. You would think that they manufacture software or like EV cars or like some kind of AI, but they're not. They're just a fashion company. You want to see an example of what goes wrong with fashion. There's a company called Kering. Kering, I'm going to butcher the spelling of this thing, but Kering owns Gucci. And, fashion is Kering. That's right. Let me get the ticker for you here. I'll pull it up on the screen. KER. Okay. So it's a European. These are the European brands, right? So yeah, it's got a little cup and handle here. We'll see what happens there. But this is a stock that was it's kind of demolished, right? Look at this. It was at $620, 280 around here. So 70% reduction because they mishandled the Gucci brand. You make a mistake with your brand, you have a bad service experience, word gets around, people stop buying your brand. It's not as durable as a software company where an engineer can fix a patch, ship it, and then you're good. So I'm not a fan of these luxury stocks. Let's see what else. He picked up Estee Lauder because I guess I'm not sure why, actually. I think the valuations are too high. I don't fully get it, although I have several friends that are managing money that have been talking about like Louis Vuitton. And this whole category just started rallying recently. I would fade it. I don't think these are real. I just don't think they have the same quality as other businesses, but I would be in the minority with that statement. Many people would take the other side of that. Now, he picked up HCA. We own this too. In fact, we bought this last week. I like a lot of healthcare ideas right now, right? Demand for healthcare is going up. It's also an implicit baby boomer theme. Baby boomers will get their healthcare. They will get their healthcare. Trump is not cutting Social Security. He's not going to cut healthcare. He'll find ways to manage costs, maybe through generics, for example, maybe through reform of Medicare and Medicaid, which is needed, maybe through stopping deduplicate payments. You guys see this? Like Elon posted this tweet showing the people that have Social Security by age, and there are dozens and dozens of people that have Social Security checks that have an age of over 200 years and some over 300, longer than the age of the American Republic. So, serious money. And HCA, take a look at HCA. I think it's a great idea. I like it a lot. Like the 4P is 12.7, trailing is 14.4. You've got earnings growth there as well. It gets better. Buyback 7.6%. Why would you own bonds when you can buy HCA, right? Why would you own bonds? Why would you own the 10-year with a yield of 4.5% that inflation eats into your return when you can own a quality compounder like HCA? What does a quality compounder mean? They can acquire other hospitals, invest in growth, and invest in themselves and grow. And HCA has a return on equity of 820%. That is just obscenely high. There's got to be some distortion there from like a sale of a business or something. But the point is, when they invest in themselves, their return on equity is very high. And I like that idea. Other names we like, by the way. Like these are areas where it's not like there's one winner take all kind of scenario, like NVIDIA versus AMD. NVIDIA is hurting AMD. NVIDIA is taking the leadership position, running in the distance and widening the gap with AMD. So in my view, you don't buy both. You focus on the leader. That's winner take all. Winner take most, let's say, with NVIDIA. Okay. But healthcare is not like that. It's highly regulated. It's state by state. You have different geographies, different specializations. Some are specializing in like ambulatory care, right? Take a look at UHS. I like this. Very similar setup, very similar pattern. And they're all cheap because of this political policy risk and, buybacks of 4.5%. It's an interesting name. It's cheaper than HCA because it doesn't have the same level of buyback. So, you're making up for in valuation. And there's Tenet Healthcare is another one. And Glenn Robbins from Larry Robbins, excuse me, from Glenview owns this one. I'm still adjusting from that Dubai trip, by the way. My sleep is a little off. It gets harder the older you get. Buyback yield 5.25, phenomenal ROE, trailing PE is very cheap. They're this is an interesting business too. We've talked about this. I have another podcast talking about healthcare stocks. This stock is up 49% in a year, right? It's a healthcare stock, up 49% in a year. Most software stocks did not do that, right? So, and if I just do a quick spot check on the valuation, again, I'm not trying to lay out the entire thesis here, just trying to show a few observations. These are the things we look at. It was in the summer, had a 17 P ratio, now it's down to 11. It's not near kind of all-time lows, but it's attractive. It has relative value as compared to other sectors in a market where you are at top decile valuations. So from a relative value basis, it is interesting. So let's go back to these other names. Okay, here's a really interesting idea. We bought this morning. It's a Druckenmiller idea. Skechers. Okay. So we mentioned earlier that apparel stocks are doing well. And the ideas that you hear and it just sounds funny, those are the ones you should pay more attention to. Okay. This is a good example of that. So you can see once again, up 5%, 4.5%. That's the 13F effect. People are doing what we're doing. They got up Monday morning and they made some buy decisions. Okay. So Skechers is one of them. Now we went deep on Skechers. Okay. Headline is this is a quality compounder. They're benefiting from the sale of footwear into the elderly segment. Once again, bet on boomers, demographics. Their shoes are comfortable. I don't own Skechers shoes, by the way. These are the shoes I'm wearing right now. I own these things. These things are so comfortable. This, and I got this from Costco. They're so comfortable. If you need to get something for your father on Father's Day, just get this and an espresso machine, and you're good. I think they will be very happy. Maybe throw in an Aura ring in there. So Skechers, they're focused on affordable, high quality footwear. Now, when I hear affordable, I get worried. Maybe affordable means low profit margin. That was the first question I asked my team. Affordable is a great value prop for the consumer, but what about the profit margins? The profit margins are great, 50% profit margin. In fact, if memory serves, it's better than Nike. Nike's at 44. So good profit margins, and they're gaining share. They're gaining share from Nike and from Adidas. Their market share went from 1.9% to 2.6%. It's when you look at a brand, it's very important to look at growth and market share. It's a good quality, right? So they are taking share. They have some trends that are working. I will share with you a screen of this market share. There we go. So you can see, 1 second here. I got it. got a 7-minute warning, by the way. So we'll have to continue more of this tomorrow because we have a lot of content, maybe on Thursday, to get through. But let me get through some of the key statistics in Skechers. So again, older demographic, they're focused on budget-conscious consumers. That is the theme in retail. It's a shift to value, a shift to convenience, a shift away from luxury brands. They're growing primarily in EMEA, that's Europe, Middle East, Africa, where they got 20% growth in that market. They're growing 10% in North America. They've got competition from On and Deck, but those businesses are more expensive. And they haven't performed well. The stocks haven't performed as well recently. I'd argue because they're more expensive, right? And investors start to pick up on new ideas. So let me show you the relative returns on these names. You can see some of the relative strength. Let's see here. There's Skechers versus some of these other names. If you look more recently, you can see On has lagged. Skechers has an interesting entry right now also. And in terms of PEG ratio, free cash flow yield, and kind of like a decile analysis of their valuations, it's the clear winner. Take a look at this. Here's some of the comps. This is comparable analysis. This is what they teach you in the CFA program, right? There's some value from the CFA program, but here's one of them. So you can see it's on the lower end of historical valuation. The PEG ratio, which takes the PE in the numerator, divides it by the earnings growth rate, nice summary statistic to see whether you're getting your money's worth when you pay up for a stock, is the lowest in the category. It's got buybacks, 9%. We like buybacks. Buybacks 3.6, free cash flow yield at 9%, which is important because that can fund the buyback, right? There's room to grow the buybacks, and it's the highest in the category. So again, cheap name. If you look at where it is today, I think it has a good entry as well. So it's up a few points, but I think it's pretty interesting. Nevertheless, here's another one I'll leave you with. We bought this. We've owned it for a while, actually. We've owned this for a while. Bought some more, I think, recently. Is Virtu. So quite a few different quant funds own Virtu, okay? So this is Doug Sifu's business. Doug was my 4th podcast guest, actually. It's a market maker. And what do you see in Virtu? You see strong momentum, trend, earnings growth. It's up 133% in a year, and the 4P is only 10 times. The reason why I like this is that you're seeing a dramatic rise in trading, retail trade. You see that in Robinhood's reports. You see that in Coinbase reports. You see that in the stock prices of NASDAQ, like NDAC and CME. They're all up and to the right, but they're all more expensive than Virtu. So this is a cheaper way to bet on that theme. In fact, those other stocks are starting to lag now. Take a look. CME, maybe that's a top there. Maybe it's going to pull back. Not saying a global top, but maybe it's going to pull back now, right? NASDAQ as well. It's, I don't know. Looks like it's consolidating here. These are popular names, but I think they are going to rotate to Virtu. In fact, Virtu's outperformed this. NASDAQ's up 49%. Virtu is up, again, 133% and just much cheaper. And with the theme that I don't think is going to stop anytime soon, right? Like retail trading is up. ETF launches are up. Volatility is up. Those businesses make money from volatility. There's like 36 different crypto ETFs that are launching. There's a handful of market makers that can service that category. So, and this is one that you can invest in, right? You can't invest in Jane Street. Yeah, I'd like to, but I can't. Here's one last one I'll leave you with. This is actually a Lumida stocking stuffer stock. 2 Sigma, a bunch of quants own this as well. It's up 7% today. Renaissance owns this as well. Dimensional Fund Advisors, kind of a quant. Millennium, and quite a few others. So this business is a bet on the rise of hormone replacement therapy. It's like an RFK bet kind of, right? I mean, so uh, there you can see some of the owners of the business, and it's very cheap. We think the entry is actually excellent now. So we picked some up very recently, and this is a small cap. This is a micro cap. This is micro cap. This is so therefore it's higher risk. It's got a very strong management team. You can take a look at it. Check out the website. What's interesting about this now is they brought on as CEO the former chief commercial officer of Pod, which is Insulet. Insulet is a diabetes therapeutics business. The name's done pretty well since the October correction. It's expensive, too expensive for my taste. I'd like to bet on the idea of diabetes therapeutics. I look at this name often. It's an interesting theme to own, but it's just too pricey for me. But the reason I point that out is they've grown earnings substantially. They've been successful despite the rise of Ozempic, which we talked about earlier, right? Ozempic should be hurting businesses like this. Another reason why I don't own this name. But they've done well. Now, why have they done well? They've done well because of their chief commercial officer who's grown earnings. So that guy is now the CEO of BTMD. He's got a 4P of 6. So if you take a look at the analysts' views on this, again, the reason the stock sold off recently is they changed management. And I don't think the market really looked into who's running the business. I always be skeptical of analyst ratings, but I'm trying to see that there are no sells. There are no sells. There are only buys, and there is no lowering of price targets after new management. The average analyst expects like 100% return. I'll be content with 20 to 30. I look for risk-adjusted returns, and sometimes magic happens. That's my approach, right? Like if I think I can underwrite to a performance that I think will outperform the S&P with maybe some right tail opportunity, and that's it. That's my approach to look at that. And then sometimes magic happens. Bumble's reporting after the close. I haven't seen their earnings. I own that. Someone just made this point here. I don't know. We own it. It's got price to cash flow ratio of 6 and a buyback yield of 20%, and they're a duopoly. So, we will wait. I think the names will slowly grind up over time. I'll take a look at earnings more closely, and we'll continue more of this in the coming days. There are quite a few names to walk through. So hope you enjoy that. Some of the names, again, we bought American Airlines, we bought Delta, BTMD, Skechers, Virtue. I think there might be a few others in there. We're just waiting for better entry points. But I hope that was helpful. Thanks for joining me today. And you can follow this, by the way, on YouTube. If you subscribe to Lumida Non-Consensus Investing, just look that up. You can also go to Spotify, wherever you listen to your podcast. We're also on TikTok, by the way. So we're trying to grow that there. All right. Have a good one. Make it a great week. Be well.